Good afternoon, everybody. Today is Friday, the 13th of January, 2012, and this is Brian Shannon speaking. Let's take a look at these markets here. We did have another constructive week for the markets. Let's take a look at the actual numbers here. You can see the S&P 500 was up just under 1% for the week, and all these averages were higher, except for oil. Oil was down 2.7%, and it's not difficult to like it when oil goes down as consumers of gasoline, obviously. But the S&P, let's take a look at the oil for one moment here. We'll take a look at the chart because it is still in an in an uptrend or recovering and at some longer term resistance near this 100 to 102 level. So oil is still constructive, I think, but good to see again as a consumer that it's not continuing to rise. You get it back up above 103ish, I guess 104, and holding above there, then I think we could continue to see the price of crude continue up towards 106 to maybe even come up towards last year's high levels. But the S&P 500, back to that, did finish higher for the week once again. We've been above the 200-day moving average for the entire for each session, that is, for this year, and we are continuing to chug forward. So today what we saw was that the key level that we were looking at as far as closing above and staying above from an intermediate term standpoint was this 128.60-ish level, and you can see that we spent a good part of the session below there after the gap lower today, and that did break this trend line as well. So we're maybe going to start to digest a little bit through time. Doesn't necessarily mean we're going to see a deeper pullback because we have this rising 10-day moving average and a rising 20 and rising 50, and we saw the volume increase here today as this market did recover throughout the day and closed pretty much right at the highs. And in fact, after hours right now, we're trading up at 129.22 is where I see it right now. So we'll see what happens as far as Tuesday goes. We have a long weekend to enjoy, but this was a constructive session, I would think, because initially it looked like this prior support was going to offer resistance, and it did twice and at that 5-day moving average, but we were able to power back above it, and again we're trading right up here in the after hours. So next week I think that today's low will be kind of the important level that we want to see hold, 127.70-ish in that general area, and this will be the first line of defense once again. Before that is about 128.60. So we continue to see constructive action in here. When we look at the longer term daily chart, we can see that we've still got that trend line just above that comes in at about 131, and that's basically a level that was pretty important throughout the year, or first half of the year last year, as well, as it became kind of an area of bigger movement once we broke above and below it. So 131 is still maybe what's looking like a target, and of course we'd been speaking several weeks ago about the inverted head and shoulders pattern in here and how this measures out. Actually, the height of this pattern, now we've broken that neckline, measures out to about 138 or so. That's a longer term type of thing to look at. We're obviously going to have a lot of volatility in between there, and we'll probably see some deeper pullbacks. And I think getting back below this 127.75, then we start to see this little pattern of lower highs and lower lows, and it'll tell us we want to stand back a little bit further and see if maybe it's the 20-day moving average that offers this support. Year to date, let's just take a look at the volume weighted average price for the S&P 500. We had, of course, we've seen once again we're seeing more gappy action in the market, but in that year to date volume weighted average price about 128.20. But again, my point I was trying to make was we're seeing the gappy action in the S&P 500 and the broader markets as well. But what's happening is we're seeing some really good opportunities in the individual stocks. I'd mentioned the other day about how some of the speculative stocks tend to move later in the cycle of a momentum move, and I didn't mean to call a top. That's not my point at all. My point was we had this 7% rally, and the markets were getting to levels of potential resistance. So it tells us you don't want to go out and get short, but it tells you that you want to look at the market and wait for further evidence and continue to play the stocks that are working and that sort of thing. So the NASDAQ broke, its first downtrend line, uptrend line, the one that's been intact year to date. We've seen that this trend line has held, and we broke below that, but we did hold our key level in here, which was support earlier in the week at 57.80. So we bounced from that level once again today. We do stand the risk that this is a lower high, and we break down and see a lower low. So I would say it's more intermediate term kind of, you could call this potential distribution. So if we break support and really back below 57.5, if we break back below 57.5, then we would probably start to look at retracement levels off this bigger rally recently and look for potential levels of support there. Now we don't want to really take that to what we're doing is looking far a little bit further ahead to say if we get a breakdown, then what do these objectives become? And right now we don't need to do that yet, but just keep in mind that's when you want to start to use those Fibonacci levels. The NASDAQ's got this trend line that it's battling with as well off the peaks from last year. And of course the peaks from last year are important levels because they've been important levels for a decade basically in the NASDAQ, as far as not important levels but high, the highs for last year. So have been decade highs in the NASDAQ. The Russell 2000 also recovered nicely this week and finished with a gain in here of, well, we're continued higher, not recovered, but we saw a gain this week of 2% in the Russell. If you recall, they were slight underperformers, and now they're kind of caught up back with the broader market. We had seen initially some horizontal resistance that broke, and then we came up to the mid-October highs from last year, and that's where we found some resistance this week. So the levels, the market's respecting these technical levels. We're closing above the 200-day moving average. We're just below this prior big level of support. And again, it might be tempting to say, hey, support broken is going to act as resistance here. There's nothing to say that it will become resistance. It does tell us, though, the market's expended some energy getting up to where we are, and we want to keep an eye on these bigger, more important levels. And in the Russell 2000, we did hold that important level of about $75.80. That holding above that, we had what's maybe a lower high. We'll see, but if we break below that 75.80 next week and hold below it for more than a half hour or so, that's the level we've been focused on this week, and it was the correct level to be focused on. And the market did that last week as well, that it really is respecting these levels, these important technical levels, the 200-day moving average, closing above it for the week. And now we've got this bigger level of 77 to contend with next week, and it might take time. As long as the market can hold up in this area, I think we're still going to see that we're getting bullish action in the underlying issues, and there's a lot more opportunity to trade the long side of the market, and we're getting better follow through on the long side of the market, individual names. So it seemed like a more normal type of week as far as individual stock movement. And I talked to a couple of people I know whose opinions I respect a lot about trading the market, and they kind of agreed with that. It kind of seemed like the good old days here for a little bit, so let's not jinx it and talk about it too much. But the markets do behave well. The semiconductors, as we know, were the first group to really kind of rally, and they had kind of the strongest rally, and they're beginning to pull back a little bit in here. I don't think it's any real reason for concern, but they did close near the lows, and this group we were looking at, an important level of 31.80, but also 31.50 has been a level of importance that we saw. That was the highs back in I just switched it around, but that was the highs back in the in mid-December. So we broke above that early in the week, and we closed above it. We're above a rising 10-day moving average. The 20-day moving average is coming up through the 50 as well, and you look at the longer term, we're still battling that 200-day moving average, so it's not all bullish, but we're getting bullish activity, and that's again something that we haven't been able to enjoy uninterruptedly, or for a bit here. And we're battling what was for the semiconductors a key level for last year as well. So keep that in mind, that we're at these important levels, that the semiconductors, this 32 and a quarter basically, had been a big level of support. When that broke, in July, and then we saw resistance in that general area. We know that we had been trapped under the 150-day moving average, made a rally for the 200. So now if we consolidate a bit in here, I don't think that's a bad thing. That we're still seeing generally bullish action. And if you take a look at this trend line, you can see that maybe it's going to follow that trend line lower and then find support a little bit lower. But we've got the first kind of break in here. If we can't get back above, probably even above the 5-day moving average, about 3180, we're going to need to see the semiconductors get back above and hold above 3180. Otherwise, these guys are giving us a little bit of reason to say be prepared for maybe a little bit deeper pullback, and we're just going to have to monitor the health. You don't want to make predictions, but you want to monitor how they pull back, and remember that the market changes. That one day something can look horrible, and it gaps up and fills in an area where there was prior resistance, and it might look bullish the next day after looking bearish the day before. And that's the art of technical analysis. I mean, you can look at how the PE changes on a stock throughout the week as well. But the point is, technical analysis is a tool. It's not a system. It gives us a good idea of what the key levels are to watch. And again, look at the financials. Look how well they're respecting this longer term trend line, and how they're battling with that 200-day moving average at the 14 level, 1420 we've been talking about. It wouldn't be surprising to see maybe a little bit of continuation through the 200-day just to kind of confuse the early shorts there. If this is in fact going to pull back, this is a bigger level of importance on the daily time frame at about 1340. But when we look at the 10-minute time frame, we can see in here that our key level in here, 1360, basically did hold as well. And we run the risk of, if we get back below 1360, well, then we want to look at the bigger picture and what might potentially be a deeper retracement. So we'll begin to throw these Fibonacci's on there and say, will these be the potential levels of support if this market does in fact break down? And you look at 1330 here on that Fibonacci, and then you look in here and say, it kind of lines up with this prior important level of 1340. So the markets, again, technical analysis, it's not a black and white system. It's an art, not a science. There's a lot of science to understanding the way it works, but when you apply it to the market, just like fundamental analysis, it's the art of deciphering that balance sheet and saying, here's what their receivables are, or their cash flow, or whatever metric it is that you look at fundamentally, that you can't trust one dimensionally from one company to another. It's the same thing with technical analysis. Where has the market come from? Where does it have the potential to go? It's enjoyed a nice rally. It's come up to a level where we anticipate that there's the potential for resistance, and now it occurs, or appears rather, that level is in fact offering some resistance, but it's not broken down yet. It's maybe the beginning stages of distribution before it breaks down, but it's definitely an area to keep on your toes, and be aware that, again, some of those little stocks moving like that generally occur towards the end of a momentum move, an intermediate term momentum move, and a little pullback wouldn't be a bad thing. We're off to a great start for this year. As we know, last year, we've already, if we closed the year here, we would have crushed last year's return. So as far as the S&P 500 and the NASDAQ goes, so continue to manage risk. That should be the goal throughout 2012, and every day that you come in with equity in your account, because that's how you come back with equity in your account day after day. Enjoy the long weekend, and hope you do something fun. Talk to you next week. Thanks.